This presentation is meant to review all the main topics of Finance 331, Financial Management 1. I'm Dr. Lynn Kugley, Instructional Assistant Professor of Finance, and I'll be the voice of these videos. This slide lists the topics covered in this presentation, and there's a lot of it. Topics are arranged so that you can select the areas you need to review and jump straight to them. The index arrow at the bottom of each slide will always take you back to this place in the presentation. We start with some basic concepts related to financial management, finance in a corporate environment, forms of business organization, creating value for shareholders, and stockholder conflicts. Where finance fits in the corporation. A publicly traded corporation has a board of directors who hires top management, the chief executive officer, the CEO. Under the CEO, the chief operating officer is basically responsible for all the operating units of the corporation, as well as marketing and human resources. The chief financial officer oversees two primary areas, the controller area, which includes accounting, and the treasury area, which includes finance. Corporate finance fits under the treasurer area, which includes cash management and capital budgeting, which is the end game focus of Finance 331. The controller usually oversees accounting and frequently information technology as well. Three main areas within the treasury function. Capital budgeting. What long-term projects should the firm undertake to make a profit? That's the main focus of 331. Capital structure relates to how the firm finances its assets, how much debt and how much equity. That's not a topic we cover in 331. Working capital management involves day-to-day management of cash flow to ensure enough cash to meet immediate obligations. Again, not a topic we cover in 331. Let's review the three basic forms of business organization. Sole proprietorship and partnerships are very similar in that partnerships are groups of sole proprietors who've banded together and agreed on how to share the costs and profits from a business. Sole proprietorships and partnerships share several advantages. They're very easy to form. You can start selling on eBay tonight and become a sole proprietor. Sole proprietors are subject to very few regulations, and there are no corporate taxes. All income is taxed as personal ordinary income. On the downside, it's very difficult to raise capital. Sole proprietors have unlimited personal liability, and sole proprietorships have a limited life. The founder dies, the business ends. Partnerships are frequently organized as LLCs or LLPs, limited liability corporations or limited liability partnerships. Each partner carries his own liability insurance, but the partnership shares costs and profits. A corporation also has advantages and disadvantages. On the pro side, corporations have an unlimited life. They are an entity separate from their owners and managers. Corporations are registered and considered residents of a state, frequently Delaware, with its attractive legal structure. It's very easy to transfer ownership in a publicly traded corporation. Just sell your shares and ownership is transferred. Shareholders, who are the owners of the company, are afforded limited liability. As a shareholder, you can only lose what you paid for the stock. Corporations have several ways to raise capital. They can issue stock. They can issue bonds. They can enter into a line of credit with a bank. On the downside, corporate profits are double taxed, once at the corporate level, again when the dividends are paid out to shareholders. The cost of meeting regulatory requirements is very high. Reporting to the SEC, annual reports to shareholders, complying with Sarbanes-Oxley. We can easily observe the current market price of a stock, but what is its true value, its intrinsic value? In equilibrium, the stock's market price and its true value should be the same. But intrinsic value is a long-term concept, and it can get out of sync with market prices if investor perceptions are incorrect. Bottom line, managers should be concerned with increasing the long-run intrinsic value of a firm's stock, not short-term bumps. Insiders to a firm know the true value of the stock. As outsiders, we observe the actions and forecasts of management and try to imply the true value with our conclusions reflected in the market price. If we interpret the signals correctly, then the stock is in equilibrium. The market price equals the intrinsic value. Let's face it, managers, as humans, frequently act in their own best interest. Wanting a better computer, want to fly first class, want to go to that conference in Cancun. Not always in the best interest of the owners, the shareholders. This is called an agency conflict, since managers are acting as agents of the owners, the shareholders. There are ways to better align management behavior with shareholder interest. Design a compensation package that rewards managers for increasing the stock price. Sometimes shareholders directly intervene at annual shareholder meetings. Firing is always an option. Firms whose management is squandering funds on trivial or wasteful items are ripe for takeover. An outsider can see that, managed well, the firm could perform much better. KKR, Kohlberg, Kravitz, and Roberts are pros at this. A second conflict involves stockholders and bondholders. Stockholders own the company. They share in its growth and profits, but have limited downside. And stockholders vote. They elect the board of directors who hire management, so basically they control the direction of the firm. Stockholders want the company to take on more risk. If it succeeds, they gain. If not, they can only lose what they paid for the stock. Bondholders, on the other hand, have loaned the company money. All they want is their interest payments on time and their principal back at maturity. If the firm turns out to be the next Google, bondholders do not share in the gain. Bondholders are opposed to anything that would damage the value of the assets securing the debt, especially the issuance of more debt. To protect their interest, bond covenants detail specific metrics the company must comply with, of the form thou shalt and thou shalt not. For example, thou shalt maintain a current ratio above 1.75, or thou shalt not issue new debt. Bottom line, the primary goal of corporate management should be to maximize shareholder wealth, which means maximize the stock price. All management decisions should be approached in terms of how they'll affect the value of the firm and thus the stock price. This ends our first part of 331 in a nutshell. In this section, we'll review some basic accounting from 331, financial statements, basic ratios, and additional funds needed, AFN. This section of the nutshell is basically an accounting review. Accounting data is important in finance as this is where we get the majority of our data to analyze. The 4 financial statements required in a firm's annual report include the balance sheet, a snapshot of the firm's financial position at a specific point in time. The income statement, which is a summary of the firm's revenue and expenses over a period, such as a quarter or year. A statement of cash flows. This is an important report for finance. It is the one that reconciles accounting statements to cash flow, which is the focus in finance. And the statement of stockholders' equity, a short but important report as it tracks how much of net income is paid out in dividends and how much is added to retained earnings. Allied's balance sheet is pretty straightforward. Assets consist of cash and cash equivalents, accounts receivable, and inventories under current assets, plus net plant and equipment. Liabilities include accounts payable, notes payable, and accruals under current liabilities, plus Allied has long-term bonds outstanding. Shareholder common equity includes both common stock and retained earnings, consistent with the basic balance sheet equation, assets equal liabilities plus equity. As is fairly typical, we report Allied's balance sheet numbers for 2 consecutive years, 2017 and 18. Note that Allied's cash position has deteriorated significantly, yet total assets have increased due to the increase in net plant and equipment. Total liabilities increased as well due to the increase in notes payable and long-term bonds. Allied's income statements for 2017 and 18 are on this slide. Consistent with our goal of keeping these statements simple and basic, their income statement is uncomplicated. Beginning with top-line net sales, we subtract operating costs to arrive at gross profit, EBITDA, earnings before depreciation and amortization. Subtracting depreciation yields operating income, EBIT, earnings before interest and taxes. Subtracting interest expense results in pre-tax income, EBT. Applying the corporate tax rate of 40%, we arrive at the bottom line, net income. Note that net income is divided between common dividends in addition to retained earnings. Additional data for Allied includes stock price, earnings, dividends, book value, and cash flow per share. We'll see the computations on the next slide. This slide recaps Allied's per share ratios for 2018. Allied has 50 million shares outstanding. Note that operating cash flow used in computing cash flow per share is equal to net income plus depreciation. Let's look at the third of the main financial statements, the statement of cash flows. It's been required since 1988 and is developed from data on the balance sheet and income statement. This is an important statement since it's the only place where accounting numbers are reconciled to cash. Accounting's matching principle requires estimates and accruals. Financial analysis is concerned with cash flow. Balance sheets and income statements can and are manipulated. Cash cannot be manipulated. Either you have it or you don't. A firm needs to translate sales and earnings into cash. This quote addresses the importance of the cash flow statement. Quote, "A positive net income on the income statement is ultimately insignificant unless a company can translate its earnings into cash, and the only source in financial statement data for learning about the generation of cash from operations is the statement of cash flows. Firms need to generate cash to continue operating." The statement of cash flows has three sections: cash from operating activities, cash from or used for investing activities, and cash from or used for financing activities. The objective is to reconcile beginning of the year cash with end of year cash. Now, Finance 331 is not an accounting course, so we're not concerned with creating a statement of cash flows, only with understanding and interpreting one. Note that in general, we want a firm to make money from operations, from what they say their business is. Allied does not, with the deficit in operating activities due to the large increase in inventories. Added to the operating deficit, Allied invested a lot in fixed assets and financed this by issuing long-term debt. Allied's statement of stockholders' equity is a simple statement since they didn't issue any new stock. Beginning of the year retained earnings plus net income minus dividends paid equals end of year retained earnings, and these figures are consistent with the balance sheet data. Before we go any further, we need to differentiate between two types of net working capital. The traditional definition of net working capital, current assets minus current liabilities. A more refined definition is net operating working capital, or NOWC. Net operating working capital is only concerned with operating assets and liabilities. Short-term investments, Allied doesn't have any, are not an operating asset. They're an investing asset. Notes payable are not an operating liability. They're a financing liability. So for Allied, net operating working capital is current assets minus the quantity current liabilities minus notes payable. The formula for free cash flow is shown at the top of this slide. Note that capital expenditures equals the change in net fixed assets from the balance sheet plus depreciation from the income statement. And yes, depreciation and amortization are added in the first component and subtracted in the second. Allied's free cash flow for 2018 is a negative $109.7 million. Negative free cash flow is generally not a good sign, but it can occur during an expansion. In this section, we'll review using financial statement data for analysis. Here's the first part of the ratios we'll be covering. Liquidity. Do we have enough current assets to meet our current liabilities? Current ratio and quick ratio are the acid test. Asset management. How well are we using our assets to generate sales? Inventory turnover, days sales outstanding, fixed and total asset turnover. And debt management. Are we using debt effectively? Debt ratio and times interest earned. Profitability. Are we making money? Operating and profit margins, basic earning power, return on assets, and return on equity. And market value. Price-earnings ratio, price to cash flow, market to book. Current ratio is one of the few ratios that has a definite benchmark. Current ratio should be greater than 1. Firms should have more current assets than liabilities. Most other ratios have to be compared to something to be meaningful. Last year, another firm, an industry average. The quick ratio is basically the current ratio with inventory removed from the numerator, since inventory may not be a very liquid asset. A firm's quick ratio may well be less than 1 depending on their level of inventory. Inventory turnover looks at how many times a year a firm sells out all its inventory. Bigger is better. This is definitely a ratio that requires comparison. It is highly industry specific. A grocery store would be expected to turn over its inventory many more times per year than a firm that makes earth-moving equipment. Days sales outstanding measures how long it takes to convert accounts receivable into cash. Remember, in finance, we're concerned with cash. When a firm makes a sale, it's booked to sales and to either cash or accounts receivable, depending on whether it's a cash or credit sale. Ideally, accounts receivable are converted to cash as quickly as possible, so the smaller the DSO, the better. Both these asset turnover ratios measure how well the firm is using its assets to generate sales. The numbers themselves are meaningless without some comparative benchmarks. Debt ratio measures how much debt the firm is using in its capital structure. Again, this must be compared to previous years and peers to have meaning. Times interest earned looks at whether the firm is earning enough to pay the interest on their debt. Bigger is better. Profitability ratios are fairly self-explanatory. Is the firm making money on its sales? Profit margin is the true bottom line, net income to sales. Basic earning power removes the effect of interest and taxes. This number is very influenced by what industry the firm is in. These return metrics, return on assets and return on equity, measure how well the firm is using assets to generate profit, how much profit is generated for a dollar of equity, and what return is being generated. These are ratios that would be of interest to investors. To give some intuition to these market value ratios, P/E ratio measures how much investors are willing to pay for $1 of earnings. Price to cash flow measures how much investors are willing to pay for a dollar of cash flow. This ratio may be used by firms who are not generating a positive income. Market to book measures how much investors are willing to pay for $1 of book value. Higher is better for these ratios. P/E ratio in particular is driven by investors' perception of expected growth. This table recaps the 5 sets of ratio we have reviewed and what questions they're designed to answer. Numbers are great for comparisons, but there can be problems. Comparing to industry averages is fairly easy if the firm being analyzed is in a single industry, Lowe's versus Home Depot, McDonald's versus Wendy's. But what if it's a conglomerate? Insiders could have access to division data, but outsiders will see consolidated statements. Even with all firms following generally accepted accounting practices, GAAP, there's quite a bit of managerial discretion as to how some numbers are handled. Without a benchmark for comparison, it can be hard to know if a number is better or worse. We've looked at only 15 basic ratios. Some may look better, some worse. So how do we know what to focus on? The DuPont Equation, or DuPont identity, was started by the DuPont Corporation in the 1920s as a way to break down return on equity, the main focus of investors, into components to identify trouble areas. ROE is equal to net income divided by equity. In the expanded equation shown, sales and total assets cancel out, leaving the basic ROE equation. But the components break ROE down into profit margin, operating efficiency, total asset turnover, asset use efficiency, and equity multiplier, debt utilization, making it easier to isolate where weaknesses are. Beyond the pure numbers, some qualitative factors should be considered. Is the firm tied to a single product, pet rock, a single customer, Walmart, or a single supplier? Continual product development and improvement is critical to long-term success. Think Apple. If one customer represents too high a percentage of your sales, they control you, but they haven't invested in you. This was Sears in the past, Walmart now. Many firms find that consolidating up and down their supply chain gives them more control. Nowadays, most firms either sell overseas or source product or raw materials overseas. This exposes firms to, at the least, exchange rate risk, as well as potential political problems overseas. Warren Buffett has said, quote, "If you've got the power to raise prices without losing business to a competitor, you've got a very good business. If you have to have a prayer session before raising the price by 10%, you've got a terrible business." Unquote. What about future prospects for the firm? And what about the legal and regulatory environment? Think pharmaceuticals. Heavy R&D expense coupled with strong regulations and long-term liability. All of these need to be considered with the numbers when analyzing a firm. This topic was covered in 331 in conjunction with the accounting review, since it depends heavily on the use of accounting data, while providing a basis for further forecasting in upper-level finance classes. The AFN, Additional Funds Needed equation, provides a basic method to value the impact of sales growth on the need for outside funding. A asterisk is the dollar amount of assets tied directly to sales. S sub 0, last year's sales. A asterisk divided by S sub 0 is the ratio of assets required to support a $1 increase in sales. It's called the capital intensity ratio. The higher it is, the more assets needed to support sales, and thus the more funding needed to support an increase in sales. L asterisk are liabilities which spontaneously increase with sales, basically accounts payable and accruals. L asterisk divided by S sub 0 is the spontaneous liability ratio, internally generated funds. Be aware that notes payable is not a spontaneous liability. It's a financing liability. S sub 1 is your forecasted next year sales. Delta S is the increase in sales in dollars. Note that this is what drives the need for additional funding. No increase, theoretically no need for more funds. M is the profit margin. RR is the retention ratio, the percentage of net income added to retained earnings. One requirement is that we must be able to assume that the ratios will remain constant. Putting the variables in place, AFN is equal to the capital intensity ratio times the change in sales. This is the total funding needed to support the forecasted increase in sales. L asterisk divided by S sub 0 times the change in sales is the amount of funding provided by spontaneous liabilities. Profit margin times new sales times the retention ratio is the amount of funding provided from the profit on the increased sales and the amount of that that's retained. This ends Part 2 of Finance 331 in a nutshell. Time value of money is one of, if not the most fundamental concept in finance. We'll cover the basics of time value of money, present value and future value, annuities, and handling uneven cash flow streams. Drawing a timeline to understand when cash flows occur can be helpful, especially when the setup is complicated. On a timeline, the tick marks the end of the period, so the 1 marks the end of period 1. The default in finance is that cash flows occur at the end of a period. Time 0 is now, today. When representing cash flows on a timeline, we observe some rules. If a cash flow is coming in to you, it's positive. Out from you is negative. A loan is income to you, so it's positive. Depositing money in a savings account is an outflow from you, so it's negative. The abbreviation CF implies that the cash flows in different periods are not the same value. The abbreviation PMT means the cash flows in each period are the same amount. Present value is the value at time 0, today. When looking at a stream of cash flows over time, present value is the current value discounted at an appropriate rate. Future value is a more intuitively comfortable concept. This relates to the value at some point in the future of an investment made today. Under different circumstances, the interest rate can be called the discount rate, the cost of capital, the opportunity cost of capital, or a required return. We'll use these terms as we move through the topics in this review and understand the different usages. We'll begin our review of TVM with future value, since it's more comfortable for most. This is the basic future value formula. Future value at a point in the future equals the present value times 1 plus the interest rate, quantity raised to the number of periods in the future. In a formula or in Excel, the interest rate is a decimal. In a financial calculator, the rate is a whole number, so 5% is entered as a 5. In your calculator, you can compute 1 plus I raised to the n power using the y to the x key. So to compute 1 plus 5% raised to the third power, enter 1.05, hit the y to the x key, press 3, and press equal. I'm providing information on the Texas Instruments Business Analyst 2 Plus, but other calculators are similar. There are 5 basic TVM keys in a row above the numeric keypad. I recommend setting decimal places to 4. On the TI, press second, format, 4, enter, quit. Double check, make sure periods per year is set to 1, which is the default. Remember that values stay in the calculator cells until cleared or overlaid, so make sure to clear the TVM registers before starting a problem. You can press second and clear TVM, which clears all 5 of the keys. Clear, C/CE, and clear work do not affect the TVM keys. We'll be working quite a bit with the calculator, but we'll cover the associated Excel functions as well. For each TVM key, there's an Excel function. You don't need to remember the exact name of the function nor the order of the parameters. Click on the FX icon and select the appropriate function. A window will appear with blanks for the needed parameters. We'll start with the formula solution. $100 invested for 5 years at 10%. In your calculator, enter 1.10, press the Y to the X key, enter a 5, press equal, and then press times, enter 100, and press equal again. Same problem solved in the calculator. It is important at this point to restate the sign convention. The calculator is programmed so that cash outflows are entered as negative values, inflows is entered as positive values. If you enter the PV as positive, the calculator assumes that you've received the funds and that you'll have to repay it with interest at some point in the future. The negative sign on the present value in this example indicates that you invested $100 for 5 years. To enter the negative 100, press 100, plus or minus, and then enter it in present value. One reason for looking at the formulas is to make these relationships clear mathematically as well as intuitively. Consider the future value formula. For a given interest rate, the longer the period, the higher the future value, meaning the longer you leave your money invested, the more you have. As N increases, future value increases. The relationship between N and future value is direct. As one increases, the other increases. In much the same way, the larger the interest rate, the larger the 1 plus I component, so the larger the future value. If you leave your money invested longer or at a higher rate, you'll have more money. For a given time period N, the higher the interest rate, the greater the future value. So the relationship between interest rate and future value is direct. Now let's turn to present value. If finding a future value is compounding, then finding a present value is called discounting. Present value discounts future values back to now, times 0. Finding a present value answers the question, how much do I have to invest today to have some specific amount in the future? What is the current value of an amount to be received in the future? To find the present value equation, we start with the future value formula and solve for PV. This is the basic discounting formula, the opposite of compounding. With compounding, future value is greater than present value. With discounting, present value is less than future value. You divide the future value by 1 plus the interest rate raised to the power of the number of periods. Here's a present value example. What is the present value of $100 to be received in 3 years if the discount rate is 4%? Finding a present value is discounting. The timeline describes the question. Using the formula, PV is equal to FV divided by 1 plus I raised to the n power. Present value is equal to $100 divided by 1.04 cubed. We can solve this in the calculator using the y to the x and 1 over x keys. Enter 1.04 y to the x 3 equals 1 over x times 100. In your calculator, use the same technique as we used for future value. Enter 4 values and solve for the 5th. N is equal to 3, IY is 4, payment is 0, future value is 100, it's positive, it's an inflow, compute PV. The comparable Excel function is also shown. Looking at the PV equation, for a given interest rate, the longer the period, the lower the PV, meaning the greater N, the larger the denominator, the smaller the result. The further in the future a cash flow will be received, the less it's worth today. The relationship between present value and N is indirect. As one increases, the other decreases. For a given time period, the higher the interest rate, the lower the present value, meaning the greater the interest rate, the larger the denominator, the smaller the result. The higher interest rate reflects greater opportunity cost or higher risk about actually receiving the cash flow in the future, making it worth less today. The relationship between present value and IY is indirect. As one increases, the other decreases. As a refresher, here's your basic PV equation. It has 4 parts: present value, future value, I, and N. In your calculator, enter any 3 plus a 0 in payment and solve for the 4th. And don't forget the sign convention. Inflows to you are positive, outflows from you are negative. An annuity is defined as a series of equal payments, inflows or outflows, that occur at regular intervals for a finite period of time. An ordinary annuity is one where the first payment occurs at the end of the period. This is the default in your calculator and in Excel. An annuity due is one in which the first payment occurs at the beginning of the period. A variation of an annuity is the perpetuity. Equal payments, equal intervals, but the period is infinite. Preferred stock is a perpetuity. First, let's get valuing a perpetuity out of the way. Simple formula. Payment divided by required return. The formulas for the future value and present value of an ordinary annuity are shown on the slide. I have no expectations that you'll actually use them, but I'm showing them for a reason. These are the future value and present value formulas for annuities due. Note the difference between the two pairs of formulas. The value of an annuity due equals the value of a comparable ordinary annuity times 1 plus the interest rate. This provides us with a solution technique. When using the TVM keys with annuities, the payment key is not 0. The sign convention is very important with payment. A wrong sign on PV or FV with payment 0 only results in the wrong sign on the other one. A wrong sign on payment can change the answer completely, not just the sign. We usually think of periods on the timeline as years, but they don't have to be. Period could mean months, weeks, whatever time frame is specified. It's important to remember that the interest rate, time period, and payment period must match. Annual periods, years, means the interest rate must be an annual rate, and any payment is an annual payment. Monthly periods means N must be the number of months. The interest rate must be a monthly rate. The payment is a monthly payment. It's a sort of a least common denominator situation. Everything, with very few exceptions, must be brought down to the smallest period. $50 a month is not the same as $600 a year. Also, the sign convention, again, is critical once payment is non-zero. First, let's look at an example of solving for the future value of an ordinary annuity. 3-year annuity, 4% annual rate. You deposit $100 each year. Payment is negative since you're depositing the 100. Future value will be positive. This problem looks the same but is slightly different. It's a 3-year ordinary annuity, 4-year rate. The question is, how much do you need to deposit, negative, now to withdraw a positive $100 each year? N is 3, IY is 4. Payment is 100, future value is 0, and you compute present value. Future value is 0 because you want to draw the account down to 0 at the end of 3 years. Solving for an annuity due can be managed by solving for the ordinary annuity and then multiplying the result by 1 plus the interest rate. First, look at the equation and the solution in the red box. We're using the fact that an annuity due is equal to an ordinary annuity times 1 plus the discount rate. This works for present value and future value. We can solve uneven cash flow streams in several ways. We can use the basic formulas, solving more or less by hand. We can use the TI Business Analyst too. We can use the TVM keys, or we can use the cash flow worksheet, or we can use Excel. And we'll look at all these methods. Here's our sample uneven cash flow stream. $200 in year 1, $400 in year 2, $600 in year 3, and $800 in year 4. If the discount rate is 12%, what's the present value? Taking the most fundamental approach, each cash flow is discounted back to times 0 and summed. This can be done either using the formula 400 divided by 1.12 squared is equal to 318.88, or using the TVM keys. N is 2, IY is 12, payment is 0, future value is 400, compute present value. To find the present value of an uneven cash flow stream, you basically just discount each cash flow appropriately and sum the values. Note that the PV formula can be presented in 2 ways, with division and with multiplication involving a negative exponent. This details using the TVM keys to find the present value of each cash flow, then adding them together to find the total present value. Either of those methods are a bit cumbersome. Fortunately, TI Business Analyst 2 has a built-in worksheet to handle cash flow streams, the CF worksheet. To access it, press CF. Since the CF worksheet has a variable number of entries, it's very important that it be cleared before starting a new computation. To clear the CF worksheet, press CF, second, clear work. The display will show cash flow 0 and all zeros. Remember that for a variable to be entered in a worksheet register, it must be keyed in and you must press enter. Think of the worksheet like a column in Excel. To move to the next cell, you move down to the next register cell. In the TI Business Analyst 2, press the down arrow. The display will show CO1 for you to enter cash flow 1. Enter it and press the Enter key and the down arrow again. The display will show FO1 for you to enter the frequency of cash flow 1. If successive cash flows are the same amount, you don't have to, but you can, enter each one separately. You can use the frequency counter to tell the calculator how many cash flows are the same. The default value is 1. You can enter that, press down again. Continue entering your cash flows and frequencies until they're all entered. To find the net present value of the uneven cash flow stream, press NPV. The display shows I is equal to all zeros, asking for the discount rate. Enter the rate, press enter, and press down. The display will show NPV. Press compute. The computed NPV will be displayed. We're going to go through an example on the next slide. We'll be using this technique quite a bit, so it's important to be comfortable with it. I strongly suggest you get your calculator and walk through this example step by step to be sure you're comfortable with the enter down process and that you arrive at the correct answer. Excel can also be used to solve for the present value of an uneven cash flow stream. One way would be to use the PVM function individually for each cash flow and sum the results, much like using the TVM keys in the TI. Excel has a built-in NPV function that can be used as well. Note that the range in the Excel function begins with cash flow 1, not CF0. We'll talk more about this later. For now, CF0 in this stream is 0. This ends our review of time value of money. This begins Part 4 of Finance 331 in a nutshell, bond valuation. When corporations raise funds by borrowing, they issue bonds. We'll cover how bonds are valued, beginning with bonds that pay interest annually and semi-annually, along with how to find a bond's yield to maturity and yield to call. Let's take a minute to look at what makes up the required return on a bond. The required return on a bond is the yield to maturity, and it's the discount rate used to value a bond. Required return on a bond is the rate that could be earned on bonds of similar risk and maturity. The components of that rate are the real risk-free rate to compensate the buyer for the time value of their money, an inflation premium based on expected inflation. The risk-free rate plus the inflation premium is the nominal risk-free rate. A maturity risk premium. Longer-term bonds have to pay a bit more since they tie up your money longer. A default risk premium based on the potential for default. U.S. Treasuries, for example, have no default risk. And a liquidity premium to compensate investors if the market for these bonds is not liquid. The market for Treasury bonds is highly liquid. The market for corporate bonds is very illiquid. This breaks the bond pricing equation into the annuity portion, the coupon payments, and the lump sum, the face value. Since the value of a bond is based on its present value, the value or the price of a bond moves inversely to market interest rates. As interest rates rise, the value of a bond declines and vice versa. We'll use the TVM keys on a TI Business Analyst 2 to value bonds. FV is the face value, usually $1,000, and it's positive. PV is the price of a bond. It's negative, what you pay to buy the cash flow stream. IY is the yield to maturity. It reflects the current market rates for similar bonds. The yield to maturity is usually equal to the coupon rate at issue, but after issue, the coupon rate is fixed. The yield to maturity changes with the market. N is the number of periods to maturity. PMT, payment, is the coupon payment. In Excel, we can use the same TVM functions we covered in the TVM review. Note that the type is always 0 for a bond. They are ordinary annuities. Let's look at a simple example. What's the value of a 10-year bond with a 10% annual coupon rate paying interest annually when the required return is 10%? Note that when the coupon rate equals the yield to maturity, the bond sells for its par value. This is always true at any time during the life of a bond. Here's the same bond value solved with the TVM keys. N is 10 years. IY is 10%. Payment is 100, 10% of the $1,000 face value. Future value is $1,000. It's a lump sum. Compute PV, you'll get minus 1,000. What if the coupon rate on the bond were 13%? With a required return of 10% and a coupon rate of 13%, Holders of this bond are getting a higher coupon payment than can currently be found in the market. The bond sells for greater than $1,000. It's a premium bond. What if the coupon rate were 7% with a 10% required return? The bond will sell for less than $1,000. It's a discount bond. So far, we've looked at how to find the price of a bond, but the truth is bond prices are quoted. They're observable. What is not observable is the yield to maturity, the market required rate of return on a bond. Yield to maturity is the discount rate used to value a bond, and as it changes, the value of the bond changes inversely. Yield to maturity is also the return earned by an investor who buys the bond and holds it to maturity. As we mentioned, the coupon rate usually equals the yield to maturity at issue, so that the bond will sell for its face value. Yield to maturity is quoted as an APR. When we look at bonds that pay interest semi-annually, this will become important. For example, we have a 10-year 9% annual coupon, $1,000 par value bond selling for $887. We're looking for the discount rate that equates the cash flow stream of coupons and face value to the current price. It's possible to solve this manually, but in an iterative manner, since we're trying to solve for the root of a polynomial of degree n. Much easier to use a financial calculator. Solving our example, we find IY is equal to 10.91%. This makes sense since the bond is selling at a discount, $887 versus $1,000, so the yield to maturity, the market rate, should be greater than the coupon rate. Remember the sign convention on the calculator. Easy way to remember it with bonds is we pay the present value, negative, so that we can receive the payment, positive, and the face value, positive. Continuing the example, if the same bond is selling for $1134.20, then the bond is selling at a premium. So the yield to maturity should be less than the coupon rate, which it is, 7.08. So far, we've looked at annual payer bonds, but in truth, bonds pay interest semi-annually. Adjustments to valuation have to be made. With a semi-annual payer, N is the number of 6-month periods to maturity. It's the number of years to maturity times 2. IY is the yield to maturity divided by 2. Remember that a yield to maturity is quoted as an APR, so we can simply divide by 2 to find the 6-month rate. Payment is the face value times the coupon rate divided by 2, the amount paid every 6 months. Here's an example. 10-year 10% semi-annual coupon bond with a yield to maturity of 13%. N is 10 years times 2, 20. IY is the yield to maturity divided by 2. 13% divided by 2 equals 6.5%. Payment is the future value times the coupon rate divided by 2. 1,000 times 10% divided by 2, $50. Solving for present value, $834.72. To solve for the yield to maturity on a semi-annual payer, N is equal to the number of 6-month periods to maturity. Payment, semi-annual interest payment. PV is the current price, FV is the face value. Solve for IY. But with a semi-annual bond, the resulting IY is a 6-month rate. It must be doubled to find the annualized yield to maturity. So far, we've focused on solving for yield to maturity, the rate earned if a bond is held to maturity. But what if the bond is callable? It may not remain outstanding until maturity. If market interest rates drop, it may be in the best interest of the issuing firm to call in a high coupon bond issue and refund it with a lower coupon issue. In that case, if market rates decline, yield to call may be a more accurate estimate of the earned yield. We solve for yield to call in the same way as for yield to maturity with 2 changes. The future value is now the call price, which includes any call premium. N is now the number of periods to the first possible call. In our example, we have a 10-year 10% semi-annual coupon bond selling for $1135.90. It can be called in 4 years for $1050. Yield to maturity is 8%. So solving for yield to call, N is 8, 4 years to the first call times 2. Present value, a negative $1135.90, the current bond price. Payment, $50. Future value times the coupon rate divided by 2. 1,000 times 10% divided by 2. The future value is $10.50, the call price. Compute IY, you get 3.568. This is a 6-month yield to call. Multiply times 2 to get 7.137. This ends Part 4 in our 331 in a nutshell. Part 5 of Finance 331 in a nutshell reviews risk and return. To review risk and return, we need to cover expected return and standard deviation in both a standalone and portfolio context. Finally, we'll review the capital asset pricing model, CAPM. Let's look at a set of hypothetical investment choices. First, the states of the economy and the probabilities of each state occurring. Next, the expected return on a treasury bill in each state. Since a T-bill is basically risk-free, the expected return is the same in every state. MP is the market portfolio. This is a theoretical construct meant to represent all traded assets. The S&P 500 is typically used as a proxy for the market portfolio. And finally, our two sample assets, HT, high-tech, and collections. We'll be using them in our examples. To begin, we need to be able to use a probability distribution to find the expected rate of return on an asset. The formula on the slide is a standard weighted average with the probabilities as the weights. Following the basic weighted average solution technique, you multiply across, add down. We'll look at a sample on the next slide. Given the data on the states of the economy and the expected return for high-tech under each state, multiply across, each probability times each expected return, sum the results to find the expected return for high-tech. Risk in finance is measured by the standard deviation of returns. Standard deviation is considered a measure of dispersion. The use of standard deviation is based on a basic assumption in finance that the returns on a stock are normally distributed. This is a strong yet empirically supported assumption. It allows us to analyze returns using parametric techniques, which are more robust than non-parametric methods. It also implies that we can describe the distribution of returns by the mean and the variance. But the problem with variance is that if returns are measured in percentages, then the metric for variance is percentage squared. Not very useful. But standard deviation, the square root of variance, is measured in percentages like expected return and is more intuitively comfortable. This formula is for the standard deviation of returns from data presented as a probability distribution, expectational data, not historical. Using high-tech as an example, we found HT's expected return is 12.4%. That value is used in the standard deviation formula. This is a case where order of operations is critical. PEMDAS. Do what's inside the parens first, then handle any exponents. Multiply, divide, and finally add and subtract. The radical, the square root sign, is handled last. Let's work through the example step by step. Given the probability distribution data, find the expected return. It's a weighted average, multiply across, add down. We find the expected return, as we found earlier, 12.4%. With the standard deviation, start with what is inside the parentheses, the deviations. Each state's expected return minus the overall expected return. Then handle the exponent, square the deviations. Multiply those values by the probabilities. Finally, add those up. That gives you the variance. And last, take the square root. That gives you the standard deviation, 20%. Repeating those calculations for each asset in the sample, the results are shown on the slide. High-tech has the highest expected return. Now, expected is in green to highlight that it means expected by you. The catch, we haven't accounted for risk yet. Here we have the expected returns and standard deviation for all assets in our sample group. T-bills, 5.5% return, 0 risk. High-tech, 12.4% return, 20% risk. Collections, 1% return, 13.2% risk. U.S. rubber, 9.8% return, 18.8% risk. And the market, 10.5% return, 15.2% risk. If you have to choose only one, how do you choose which asset to invest in? None of them have the same expected return or the same risk. The solution is the coefficient of variation, standard deviation divided by expected return. Risk per unit of return. Lower is better. Coefficient of variation allows us to choose one asset to hold in isolation from a group of assets. Here are the coefficients of variation for all our sample assets. Collections has a very high CV, low return, high risk. High-tech, which had the highest risk metric, is really only slightly riskier than the market. The expected return of a portfolio is simply the weighted average of the expected returns of the assets in the portfolio. The weights in this case are the percentage of the dollars invested in each asset. Assume a two-stock portfolio is created with $50,000 in high-tech and $50,000 in collections. In this portfolio, the weights are 50-50. We calculated the expected returns of both assets previously. High-tech 12.4, collections 1. So the expected return of our portfolio is 0.5 times 12.4 plus 0.5 times 1, 6.7%. On the previous slide, we used the expected returns for each asset that we had already computed. Looking at an alternative method here, step by step. First, we calculate the return during a recession of a portfolio of 50% high-tech, 50% collections. Then repeat the calculations for each state of the economy. Then we multiply those results times the probability and sum the results. That's our portfolio return, same as we found with the first method. The reason for looking at this approach? We'll need these figures for portfolio standard deviation. Portfolio expected return is pretty simple. Portfolio standard deviation is not a weighted average of the standard deviations of the assets in the portfolio. If it were, there would be little benefit to diversification. This is the formula for the standard deviation of a portfolio. It looks and works in a manner very similar to the formula for a single asset. Again, be aware that this is for use with expectational data, not historical. Probabilities imply expectations. Using historical data requires a slightly different formula, and be very careful to follow the order of operations. Calculating the standard deviation and coefficient of variation for our 50-50 portfolio, we find a standard deviation of 3.4% and a coefficient of variation of 0.51. This standard deviation is much lower than the standard deviation of either stock. Why? Negative correlation. The returns on these two assets move opposite to each other. High-tech is cyclical, collections is counter-cyclical. Placed together in a portfolio, they offset each other. This calculates the standard deviation of the 50-50 portfolio in a more familiar table format. Here's where we use the other approach from a few slides back. Step 1, calculate the expected return of the 50-50 portfolio in each state of the economy. Step 2, find the deviation of each portfolio expected return from the overall expected return. For recession, that would be 0 minus 6.7%. Step 3, square the deviations. Step 4, multiply the squared deviations by the probability for each state of the economy. Step 5, sum the deviation squared times probability results. This is the variance of the portfolio returns. Take the square root of the variance to find the standard deviation, 3.4%. This table recaps our results for both stocks individually and together in a portfolio. It highlights the significant reduction in risk by combining the two risky stocks into a portfolio. Negative correlation. The returns on these two stocks move opposite to each other. The drastic reduction in risk in our sample portfolio was driven by the strong negative correlation between high-tech and collections. Correlation is a binary metric, meaning in this case it measures how the returns on two assets move together or not. Perfect correlation, rho is equal to 1, means the returns move exactly together. The correlation between most stocks in our markets is about 35%. That means combining stocks in a portfolio generally reduces risk. The light blue in the graph is market risk, the risk of being in the market as opposed to investing in the risk-free asset. We'll see that the darker blue is diversifiable risk, risk that can be reduced by diversification. Reduced, not totally eliminated. The standard deviation overall risk of a portfolio decreases as stocks are added because they would not be perfectly correlated with the existing portfolio. Expected return of the portfolio would remain relatively constant. Eventually, the diversification benefits of adding more stocks dissipates after about 40 stocks, and for large stock portfolios, risk tends to converge to about 20%. So far, we've focused mainly on standalone risk, the risk of holding a single asset in isolation. Standalone risk has two components: market risk, systematic risk, risk that cannot be eliminated by diversification, the light blue on the previous graph. Market-wide events such as inflation or high interest rates, and it's measured by beta. Diversifiable or unsystematic risk is risk that can be eliminated by diversification. The dark blue on the graph. Events localized to a company or an industry. If an investor chooses to hold a one-stock portfolio, he doesn't diversify, the investor will not be compensated for the extra risk they bear. Standalone risk is not important to the well-diversified investor. The well-diversified investor is concerned with the contribution an asset makes to his portfolio. CAPM was developed in the early 1960s by William Sharp, 1964, Jack Trainer, 1962, and John Lintner, 1965, A&D, and Jan Mawson, 1966. Interestingly, only one of these men, William Sharp, received the 1990 Nobel Prize in Economics for this work. CAPM links risk with required return. Remember, what we found using a probability distribution was expected return, expected by you. Required return is the return that the market demands for the amount of market risk an asset has. CAPM defines a security market line, the SML, a linear equation that states that a stock's required return equals the risk-free rate plus a risk premium, reflects the stock's risk after diversification. Conclusion: the relevant riskiness of a stock is its contribution to the riskiness of a well-diversified portfolio. Beta reflects the volatility of the stock's returns versus the volatility of the market. It indicates the contribution of an asset to a well-diversified portfolio. By definition, the beta of the market is 1. A beta greater than 1 implies the stock is riskier than the market. Less than 1, less risky. Most betas tend to be between 0.5 and 1.5. The CAPM equation is presented in two forms, with the return on the market minus the risk-free rate, or with the risk premium on the market. These are equivalent and represent the market risk premium, the additional return over the risk-free rate demanded by investors to compensate them for the risk of investing in a risky asset. The market risk premium is not static. It depends on the perceived overall risk of the market and investors' degree of risk aversion, which changes over time. Using the CAPM SML equation in our given data, we can compute the market required return for each asset in our sample, for high-tech first, and then for the rest of our sample. Now we have two return metrics for each asset: expected return, expected by us, calculated from a probability distribution, and required return, required by the market. A stock is priced to earn this return. Comparing expected versus required gives us an indication of whether an asset is underpriced, overpriced, or fairly priced. High-tech appears to be undervalued, since we think it's going to return 12.4%, but it's priced to return 12.1%. Conversely, collections in U.S. rubber appear to be overpriced. If we feel good about our expectations, we would buy high-tech and sell or short collections. Plotting these values on the security market line, we see that high-tech plots above the line since it's expected to return more than required. U.S. rubber and collections plot below the line. So what'll happen? Price pressure from trading will force high-tech down and collections in U.S. rubber up, because they all should plot on the line. Notably, CAPM is applicable to an individual asset or to a portfolio. If we have a beta, we can use CAPM. The beta of a portfolio is simply the weighted average of the betas of the assets in the portfolio, with the weights equal to the percent of dollars invested in each asset. In other words, this formula is virtually the same as the expected return on a portfolio. Same weights, different weighted values. Let's work through an example of a portfolio beta calculation. Continuing our sample portfolio of 50% high-tech, 50% collections. High-tech's beta is 1.32. Collections beta is minus 0.87. So the beta of the portfolio is 0.5 times 1.32 plus 0.5 times a negative 0.87, equal to 0.225. We can find the required return on our portfolio in two ways. First, the required return on the portfolio is a weighted average of the required returns on the two assets. Since it's 50-50, it's a simple average. Second, we could use the portfolio beta in the CAPM equation. 5.5% plus 5% times 0.225 equals 6.625. Same answer either way. The security market line is not static. It changes as its components change with the market changes. If inflation expectations increase by 3%, but the market risk premium doesn't change, then the SML line shifts up. Inflation expectations increase the risk-free rate, which is the y-axis intercept. If investors' risk aversion increases but the risk-free rate stays constant, then the line will ratchet up, affecting high beta stocks more than lower beta stocks. CAPM has not been empirically verified, though it's been studied since it was introduced in the 1960s. There are statistical issues with trying to verify it. A main issue is that CAPM is an expectational, an ex-ante model, yet any attempts at verification use historical or ex-post data. In addition, there's been a significant amount of research looking at other factors that can influence required return. Chief among this research line is the work of Fama and French, who found that required return is influenced by a firm's market-to-book ratio and market capitalization. If investors are concerned about standalone risk as well as market risk, CAPM may not produce a valid estimate of required return. With all the continued research, CAPM is still the primary model used to depict the relationship between risk and required return. This ends Part 5. Part 6 of Finance 331 in a nutshell: stock valuation. To value common stock, we'll review 3 approaches: the constant growth model, the non-constant growth model, and the corporate value approach. We started our valuation of capital assets with bonds, since bonds are much easier to value than stock. Recall that the value of a financial asset is the present value of its future expected cash flows discounted at an appropriate rate. With a bond, at the time it's issued, we know exactly what each interest payment will be and when it will be paid. We know exactly how long the bond will be outstanding and exactly what we'll receive at maturity. Contrast that with common stock, which has an infinite life. We don't know what we'll sell it for or when we'll sell it. We don't know if it will pay dividends or how much they'll be. Definitely a bigger challenge. So technically, the value of a share of common stock is the present value of all its future dividends, to infinity. The fact that common stock has an infinite life means there's no closed-form solution to the valuation model, so we have to make some simplifying assumptions to come to a valuation formula. If we assume that a firm's dividend grows at a constant rate forever, using a Taylor expansion and a lot of math, the infinite valuation model can converge to a constant growth model. This is called the constant dividend growth model or the Gordon growth model. Note that D0 is the dividend just paid, so it's known, it's history. RS is the required return on the stock, and G is the constant growth rate. Be careful as to whether a problem gives you D0, the dividend just paid, or D1, the next expected dividend. So what happens if the growth rate is larger than the required return? The formula returns a negative stock price, which is not feasible. So the constant growth model requires that the required return is greater than the constant growth rate, and the dividend is expected to grow at a constant rate forever. Let's look at each component of the equation. D0 is the dividend just paid. D1 is the next expected dividend. By definition, D1 is equal to D0 times 1 plus the growth rate. G is the constant growth rate, and RS is the required return on the stock. So where do we get this? CAPM. If we're given a risk-free rate of 7%, a return on the market of 12%, and a beta of 1.2, we can find the required return on this stock, 13%. Given dividend at time 0 of $2, a constant growth rate of 6%, and a required return of 13%, we have all we need to find the price. Using the constant growth model, the price at time 0 now is $30.29. Let's step back and look at our constant growth formula on top. We're usually solving for the price today, P0. But given D0 and a constant growth rate, we can find the price at any time in the future. So the price at time t is equal to the dividend at time t plus 1 divided by the required return minus the growth rate. As long as the dividend growth can be reasonably assumed to be constant forever, finding the value of a share of stock is fairly easy. But what if the stock is growing at a supernormal rate for a few years before settling into a stable growth pattern? We obviously can't use the constant growth model, at least not for the non-normal years, but at some point the growth does become constant. Let's assume our stock is going to grow at 30% for 3 years, then stabilize at 6% forever. The required return is still 13%. This timeline chart lays out the solution technique. Put the growth rates and required return on the timeline. Calculate the non-constant dividends and the first constant dividend, D4. Use the first constant dividend to find the horizon value, or the stock price at the end of the non-constant growth period. The horizon value is the first constant growth dividend divided by the quantity required return minus the growth rate. Note that the horizon value here is P3. It's equal to D4 divided by R minus G, and it's discounted back 3 years. D4 is not used for anything else. Discount each non-constant dividend and the horizon value back to time zero. Sum the discounted values to find the stock price. Once you have the timeline set, you can solve the problem in the cash flow worksheet in your calculator. CF0 will be 0. D0, the dividend now, is history. We're interested in future dividends. CF1 and CF2 are D1 and D2. CF3 includes both D3 and P3, the horizon value of the stock at time 3. With a required return of 13%, solve for NPV and arrive at the same answer, $54.107. Our third valuation technique is called the corporate valuation model, or the free cash flow model, which values the entire firm, not one share of stock. Remember from our earlier review of accounting, free cash flow is the after-tax operating income minus net capital investment, and the formula is shown on the slide. Using the free cash flow model, we don't find a share price, we find the value of the firm in total. To find the value of a share of stock, we need to subtract the market value of debt and preferred, and divide the resulting value of common equity by the number of shares outstanding. The free cash flow model is often preferred to the dividend model since it can be applied to firms that do not pay a dividend or to ones whose dividend is hard to forecast. The model does assume that at some point free cash flow will stabilize at a constant growth rate. So it can also be applied to firms whose free cash flow grows at a constant or non-constant rate. Where we found the value of a share of stock at the end of the non-constant period, in the free cash flow model, we find the horizon value, or the value of the firm at the end of the non-constant growth. Recall our basic valuation model for a share of stock and how by assuming a constant growth rate, we could simplify it to the constant dividend growth model. We can do the same with the free cash flow model. Note that when using free cash flow, we are discounting by the firm's weighted average cost of capital, the required return on all the firm's assets. Using the same assumption of constant growth, we can simplify to an FCF version of the constant growth model. Let's walk through an example. Free cash flow for the past year, FCF 0, was $100 million. Pay attention to the FCF 0 or free cash flow 1, same caveat as with D0 and D1. Constant growth rate, 8%, cost of capital, 12%. The market value of the firm's debt and preferred is $500 million, and the firm has 50 million shares outstanding. Using the free cash flow constant growth formula, we find the value of the firm is $2,700 million. Subtracting debt and preferred, the value of common equity, $2,200 million. Dividing by the 50 million shares results in a stock price of $44. With free cash flow, non-constant growth is frequently not a constant percentage, but rather estimates of free cash flow dollars. Other than being presented with the dollars, the technique is the same as with a non-constant growth stock. Here we find the value of the firm is $416.942. The firm has $40 million in debt and preferred and 10 million shares. Value of common equity, $416.942 minus 40, $376.94. Divide by 10 million shares, share value $37.69. This ends Part 6 of our nutshell. Part 7 of Finance 331 in a nutshell reviews the weighted average cost of capital. We'll start bringing together all the elements we've been reviewing. We'll cover computing each component, adjusting for flotation cost and risk, and calculating the weighted average cost of capital, the WACC. This is the weighted average cost of capital formula. The W factors are the weights, the percentage of each component that make up the funding of the firm. The R components are the cost of each type of capital, the cost of debt, the cost of preferred, etc. T is the firm's corporate tax rate. We'll look at how we arrive at each variable in this equation. The weights used in the formula represent the percentage of the firm funded by each source of capital. The optimal source for weights is the firm's own target capital structure. As an insider, you may have access to this data. As an outsider, you may not. The next best choice is to use market value weights. Market value of equity is just the number of shares outstanding times the price per share. Market value of debt is the number of bonds outstanding times the current selling price per bond. Using book value is a last resort, since book value may not correctly reflect market values. Let's work through an example to see how all this works. Coleman Technologies has a 40% tax rate. They have bonds outstanding with a 12% coupon paid semi-annually and 15 years to maturity. They currently sell for $1153.72. We're going to ignore flotation costs for new debt. Coleman has preferred stock with a 10% annual coupon selling for $111.10. Note that the $100 par value of the preferred stock is irrelevant to our calculations. We need to use the current market price. Coleman's common stock is selling for $50 a share. Last dividend was $4.19, and Coleman expects the dividend to grow at a constant 5% forever. Coleman stock has a beta of 1.2. Current yield on Treasury bonds is 7%. Market risk premium is estimated to be 6%. Coleman's target capital structure is 30% debt, 10% preferred, and 60% common equity. Beginning with the debt component. We already know the weight of debt, 30%. The cost of debt we need is the marginal cost, the cost of the next dollar of debt raised. That equals the yield to maturity on Coleman's current debt. And don't forget, interest on debt is tax deductible, so we adjust the cost of debt accordingly. With a maturity of 15 years and semi-annual coupons, N is 30. The coupon of 12% annually equals $120 divided by 2, so payment is $60. Current price is entered as a negative present value. Future value is $1,000. Solve for IY, 5%. But this is a semi-annual bond, so we need to double the resulting IY to find the annual yield to maturity of 10%. To compare the cost of debt with the cost of other capital components, we need to view the after-tax cost. 10% times 1 minus the tax rate, 6%. Moving across the equation, our next component is the cost of preferred. And again, we need a marginal cost, the cost to Coleman if they issued preferred stock now. Preferred dividends are not tax deductible, so there's no tax adjustment, and we'll ignore flotation costs at this point. The formula for the cost of preferred is merely the basic constant growth model with growth equal to 0. Also, note that the equation uses the current price, not the par value. Since most common stock doesn't have a par value, this doesn't come up with common, but preferred frequently does. The cost of preferred is equal to $10 divided by 111.10, 9%. The last component cost of capital, equity. Equity can come from two sources. RS is the cost of retained earnings. RE is the cost of new equity. Recall that retained earnings belong to the shareholders. They just aren't paid out as dividends, but retained to reinvest in the firm. Retained earnings have an opportunity cost. If it had been paid out, the shareholders could have earned a return on it, or the firm could have repurchased their own stock and earned the return. So retained earnings are not free money. They're easy, but they're not free. We have two methods to find an estimate of the cost of retained earnings. CAPM, which we covered in risk and return, discounted cash flow model, which we covered in stock valuation. To find the cost of equity using CAPM, we need to find a proxy for the risk-free rate, typically the long bond, the 30-year Treasury, estimate the market risk premium, or determine a proxy for the return on the market, typically the return on the S&P 500. Find or calculate beta. Substitute these into the CAPM-SML equation. For Coleman, the data was given. 7% risk-free rate, 6% market risk premium, 1.2 beta. Substituted, we find a cost of equity, 14.2%. To use the discounted cash flow constant growth model, we need three pieces of data. The current stock price, observable. The current or last paid dividend, published data. The constant growth rate. We need an estimate of that. The growth rate is the one variable that we cannot observe, and we have two choices as sources. We could use historical data to estimate a growth rate, assuming the future will be like the past, or we could use analyst estimates, and there are many published forecasts, but analysts forecast earnings growth, not dividend growth. Using our given data, the last dividend was $4.19, price per share of the stock $50, growth rate 5%. Substituting that in, we find a cost of 13.8%. So here we have our two estimates. We might justify using the midpoint of 14%, or if we felt strongly about the quality of one estimate over another, we could elect to use it. The cost of issuing new common stock is greater than the cost of retained earnings. Issuing securities involves flotation cost, the cost of underwriting, legal fees, etc. When an established firm with common stock outstanding issues new equity, it's a negative signal to the market. The intuition is that it's the firm's last resort. Based on pecking order theory, a firm uses retained earnings first. If funds are still needed, they go to debt, less costly, no ownership dilution. Last resort, new equity. Stock prices move on news, and the announcement of a stock issue is news, not the actual issue. So when the issue is announced, the stock price may fall on the news, requiring the firm to issue more shares to raise enough funds. Adjusting for flotation cost uses the DCF model. Continuing our Coleman example with the addition of a 15% flotation cost. The flotation cost is incorporated into the denominator of the constant growth model, reducing the price received by the issuer. The cost of new equity rises to 15.4%. Ignoring flotation cost and using the cost of retained earnings as the cost of equity, we substitute into the cost of capital equation and find a cost of capital 11.1%. You hear firms talk about their hurdle rate, the return that all projects must meet or beat to be accepted. But should the composite cost of capital be a hurdle rate? No. The firm's overall cost of capital reflects the required return on a project with the average risk of all of the firm's projects. Different projects, different divisions have different risks. The cost of capital should be adjusted. Looking at this, which projects would be accepted if the firm used the 15% cost of capital for the hurdle rate? Compare 15% to the expected returns and accept project A and B. But what if we risk adjust? Using the 15% as a hurdle rate was seen on the last slide. Now, which projects should be accepted if we use the required return based on the risk of the project? We'd accept B and C and reject A. When we used the cost of capital as a hurdle rate, we accepted a risky project A that we shouldn't have, rejected a less risky project C that we should have accepted. Following this policy, the overall risk of the firm will increase over time. Graphically, the red line is the weighted average cost of capital, the hurdle rate. Take everything above it, reject everything below it. The blue line is the risk-adjusted cost of capital. This demonstrates the fallacy of using a flat hurdle rate. If the company didn't risk adjust, it would mistakenly accept project H and reject L. If it correctly risk adjust, it would accept project L and reject H. This ends Part 7 of 331 in a nutshell. In Part 8 of Finance 331 in a nutshell, we're going to look at methodologies for evaluating projects. In this section, we'll review the mechanics of capital budgeting, the metrics we use to evaluate potential investment projects. We'll cover 5 methodologies: net present value, internal rate of return, modified internal rate of return, payback, and discounted payback. While one method, NPV, dominates, all 5 provide information about the viability of potential investments. Here are the 5 steps involved in capital budgeting analysis. Number 1, estimate the cash flows. That's our final topic in Part 9. Number 2, assess their riskiness with cash flow estimation. Number 3, find the weighted average cost of capital. We did that in Part 7. Number 4, find the NPV and internal rate of return. That's in this segment. And decide accept or reject the project. Also in this segment. An independent project is one whose cash flows do not affect any other project. If 2 or more projects are mutually exclusive, taking one automatically precludes taking the other. For example, the decision as to whether to build a plant on a plot of land or sell the land are mutually exclusive. You can do one or the other. If projects under analysis are independent, a firm can choose all, none, or any set. Why is this important? If a group of projects are independent, then we only need to decide go, no-go on each one. If the group is mutually exclusive, then we must be able to select the best project, the second best, etc. We must be able to rank them. And as we'll see, not all evaluation methods are capable of ranking. Net present value is the dominant capital budgeting evaluation metric. Technically, for a normal cash flow project, it's just the sum of discounted inflows netted against the time zero investment. More generally, this is the main use for the cash flow worksheet and the TI Business Analyst too. This is what it's made to do. Looking at a sample project, here's the calculation of its NPV. Discount each cash flow and add them up. Since cash flow 0 isn't discounted, its value remains the same. Each successive cash flow is discounted by dividing by 1 plus the cost of capital raised to a power equal to the period. So the year 2 cash flow of $60 is divided by 1.10 squared. Note that the Excel function in the example, Excel has an NPV function with a slight peculiarity. Cash flow zero cannot be included in the range inside the function. It has to be handled outside. Apparently, NPV was designed this way originally in Excel, and it can't be changed now. If you've kind of gotten vague about this, it would be a good idea to follow through that example in your calculator and make sure you can arrive at the correct answer. NPV meets all the desired criteria for a capital budgeting method. All the cash flows are considered in the computation. In other words, we use all the data we have. Time value of money is considered. Net present value can be used to rank mutually exclusive projects. Net present value is directly related to the value of the firm. In theory, if a project is accepted and pursued, the value of the firm will increase by the amount of the NPV. NPV is the dominant method. It always prevails. If other techniques give conflicting accept-reject decisions, NPV is the final word. Closely related to NPV is the internal rate of return, or IRR. IRR is the discount rate that makes NPV zero. While it's possible to solve for IRR manually, it's iterative, meaning you try values till you hit the answer. There is no closed-form solution to this. Much easier to use your financial calculator or Excel. In the TI Business Analyst 2, you enter the cash flows as you did to solve for NPV. Or if you just solve for NPV, the values are still in the worksheet. Instead of pressing NPV, press IRR and compute. In Excel, the IRR function allows you to enter a guess, but it's not required. And the IRR function expects the entire cash flow range, cash flow 0 to cash flow n. IRR has several strengths, not the least of which is that it's preferred by executives who seem to like a percentage return. It does consider all the cash flows, and it does consider the time value of money, and it does provide some indication of risk. Consider, if the IRR of a project is 15% and the firm's cost of capital is 10%, there's a lot of leeway to make errors in cash flow estimation and still have a profitable project. If the firm's cost of capital is 14%, not so much. IRR does, however, have some serious flaws. As shown, you cannot use it to rank mutually exclusive projects. Two more serious issues are the problem of multiple answers and the reinvestment assumption. IRR assumes that all cash flows are reinvested at the internal rate of return, which is often untrue and will bias the resulting internal rate of return. Looking at the NPV and IRR formulas together. With NPV, we solve for a dollar amount. With IRR, we're solving for the root of a polynomial of degree n. A solution to problems with the internal rate of return method is to use the modified internal rate of return. The formal definition is on the slide, but I think it'll be more useful to see this charted. Using our sample project as an example. Our first step is to find the future value of all inflows, all positive cash flows. Note that the TI Business Analyst 2 does not solve for the future value of an uneven cash flow stream, but it's easy to find it in your calculator. Simply find the NPV and then future value it to the end. In this example, the cash flow 1 of $10 is future valued 2 years, so it's 10 times 1.10 squared. The $60 is future valued 1 year, and the 80 is already at the end of the timeline. These are added together. We need to find the discount rate that will grow the $100 outflow at time 0 to the terminal value of inflows of 158.1. You can solve this with the TVM keys, as we'll see on the next slide. Enter the values in the TVM keys. N is 3, present value is a negative 100, payment is 0, future value is the terminal value of the inflows, 158.1, compute IY, 16.5. In Excel, you can use the rate function. Excel also has a dedicated MIRR function. Note that the Excel MIRR function asks for 2 rates. The finance rate is the discount rate applied to the outflows. Since we only had one outflow, this wasn't used. The reinvestment rate is the future value rate. For any problems we have, we used the weighted average cost of capital for both. This recaps the Excel functions for our sample project, computing NPV, IRR, and MIRR. A project with normal cash flows has one outflow investment at time 0, followed by a series of positive inflows for the life of the project. One change in sign from time 0 to time 1. Non-normal cash flow stream has 2 or more changes in sign. An example frequently given is a strip mine, where the land must be reclaimed when the mine is exhausted, causing a large negative cash flow at the end of the project. In solving for IRR, we're solving for the root of an n-degree polynomial. Descartes' rule of signs says that there will be one real root for each sign change, with the remaining roots imaginary. For a project with non-normal cash flows, that means for each sign change, you get a real solution to internal rate of return. As an example of multiple IRRs, suppose we have the Pavilion project. At time 0, we need to invest $800,000 to build a World's Fair pavilion. During the fair, we estimate we'll make $5 million, but it will cost us $5 million to put the land back like it was after the fair closes. These values are shown on the timeline with the cost of capital 10%. Solving for NPV, we get a negative $386,776.86. IRR results, we get an error, or maybe we get 25%, or maybe we get 400%. 25 is possible, 400 is not. The problem is the two sign changes. MIRR can solve the multiple internal rate of return problem. All the outflows are present valued to time 0, and summed to use as the present value. Outflows to the left on the timeline, inflows to the right, future valued to the end of the project. With the Pavilion project, we have two outflows at time 0 and time 2. The cash flow at time 2 must be discounted back to time 0 and added to the cash flow at time 0. So you've got minus $5 million divided by 1.10 squared is equal to a negative $4,132,231.40. Adding the initial $800,000 outflow results in a present value of a minus $4,932,231.40. Future valuing the $5 million at time 1 forward gives you $5.5 million. In your calculator, N is equal to 2. Present value is equal to a negative $4,932,231.40. Payment is 0. Future value is $5.5 million. Compute IY and get a 5.6%. The project is a no-go with an MIRR of 5.6 versus a cost of capital of 10%. Our last two methodologies are payback and discounted payback. Payback is the number of years to recover the project's initial cost. It's one of the easiest to understand metrics, and we'll walk through an example. Using our sample project again, accumulate the cash flows from time 0 to the last year. We're looking for when the sign of the accumulated cash flows changes from negative to positive. For our project, the sign change occurs between years 2 and 3. A fundamental assumption in finance is that cash flows occur at the end of each period, but in this specific case, we assume they are evenly spread throughout the year. So we want to know how far past year 2 toward year 3 we have to go to exactly pay back our initial investment. The logic in this example is that at the end of year 2, we're still short $30, but by the end of year 3, we earn another $80. So how far into the year do we have to go to cover that $30? We find the fraction by dividing the last negative cumulative cash flow by the cash flow in the next year and taking the absolute value. In this case, that is the absolute value of minus 30 divided by 80, or 0.375. Add that to the year, the last year with a negative cumulative cash flow, and you have payback, 2.375. One major problem with payback is that it ignores the time value of money. Discounted payback solves that issue. Technique is exactly the same, except the cash flows are discounted before they're accumulated. Two things to note. Discounted payback will be longer than payback. The sum of the discounted cash flows will always equal the NPV. In summary, with today's computing power, it's easy to calculate all the metrics. While NPV is the dominant one, each does provide valuable information. NPV is a dollar value and indicates the expected increase in the value of the firm. IRR is a percentage and does give some indication of risk. MIRR is a percentage and corrects problems with the internal rate of return. And payback and discounted payback are in years, and they give you some indication of liquidity. This ends Part 8. Part 9 completes our review of Finance 331 in a nutshell, bringing it all together to see how to evaluate a project and decide go or no go. which cash flows are relevant for our analysis, how to handle depreciation, which is non-cash but relevant due to the impact on taxes and net income, how to handle salvage values. Then we'll go over a sample project analysis. And our closing topics include how to incorporate inflation in your analysis and two types of risk analysis, sensitivity and scenario. At a very basic level, we're concerned with the firm's cash flows with the new project minus its cash flows without the project, the incremental cash flows generated by the project. Relevant cash flows. Changes in net working capital are relevant. Typically, at the beginning of any project, there's an investment in inventory or material or spare parts, which is a use of cash, but it's partly offset by a spontaneous increase in accounts payable. Interest and dividends are not relevant. The assumption is that all projects are funded by the same mix of debt and equity as the firm, which is reflected in the weighted average cost of capital. To charge a project with interest or dividend expense would be double counting. Sunk costs are not relevant. Any expenses already incurred or committed are not relevant. For example, a pilot study done last year is not relevant to today's decision. Opportunity costs are relevant. Opportunity costs are the cost of an option not taken. These usually involve a physical asset, a plot of land that the firm owns that could be used for this project or sold. It's not free. The project should be charged with the next best thing that could be done with it, what we could receive for selling it. Externalities and cannibalism, they are relevant. Firms frequently build on a successful product with extensions to the line. The Big Bertha may lead to a bigger Bertha, which may take sales away from the original. The loss of revenue is a cost to the project. Externalities can be positive. The iPhone XR may generate sales of the iPhone 8 Plus as it'll be cheaper. Tax effects are relevant. Taxes are paid in cash and they must be considered. Though depreciation is a non-cash expense, it affects income since it impacts taxes, which are cash, so we need to understand how it works. The simplest method is straight line, where the value of an asset minus its salvage value is depreciated over a number of years equally. Firms can, and some do, use this method for reporting to shareholders, but they must use the Modified Accelerated Cost Recovery System for tax reporting. Modified Accelerated depreciates all assets to zero without any consideration for salvage value. Assets are assigned by the IRS to a class defining the recovery period in years. A half-year convention is applied so that all assets are assumed to be placed in service mid-year the first year. This leads to a 3-year asset being depreciated over 4 years. Under Modified Accelerated, the depreciation basis includes the cost of the asset plus any shipping cost and any installation expenses, the cost to put the asset in service. Modified Accelerated Cost Recovery depreciates an asset to a zero value, so when the asset is sold at the end of a project, there are tax implications. The net salvage cash flow is the cash received from selling the asset minus any taxes paid. You're taxed on the difference between the selling price and the book value. This equation was not in your textbook, but leads to the correct end-of-project net salvage cash flow. If the selling price is greater than book value, then you pay tax on the gain. If the selling price is less than book value, you recover tax on the loss. Let's walk through a sample project and see how all the pieces fit together. First, the given data. Equipment needed will cost $200,000. The cost to ship and install it, $40,000. This makes the depreciable basis $240,000. The new project will require an increase in inventory of $25,000, a use of cash. Accounts receivable is expected to increase by $5,000, a source of cash. So the net change in net working capital is $25,000 minus $5,000, $20,000. Expected results, new sales of 100,000 units a year at $2 a unit, with the variable cost running 60% of sales revenue. The project will last for 4 years. The equipment will be depreciated under the Modified Accelerated 3-year class. The equipment is expected to be worth $25,000 at the end of the project. The tax rate is 40% and the cost of capital 10%. Note that the project has a definite finite life, 4 years. In capital budgeting, regardless if the project is expected to go on forever, it has a definite life. The assumption is that at the end of the project, all equipment purchased will be sold for salvage. In addition, inventories and accounts payable will go back to pre-project levels. Thus, the change in net working capital will be recovered. First, let's find the depreciation values to be expensed each year. The rate percentages are defined by the IRS and are applied to the depreciable basis of $240,000. The values in the depreciation column are the annual dollars expensed as depreciation using the Modified Accelerated Cost Recovery System method for a 3-year class asset. Putting it all in a pro forma statement format, revenue, 100,000 units times $2 each, $200,000 a year. Operating costs, 60% of revenue, $120,000 each year. Depreciation expense, calculated on the previous slide. Revenue minus cost minus depreciation equals EBIT. Taxes, 40% of EBIT. Subtract taxes. Add back depreciation. It's a non-cash expense that must be considered for tax reasons, but we're solving for cash flow. Operating cash flows are the bottom line. We recover all investment in net working capital in the final year of a project, so the $20,000 is an inflow in year 4. We were given that the equipment would be worth $25,000 at the end of the project. Since it was depreciated to zero book value, the entire $25,000 is a taxable gain at 40%, $10,000 tax. Net salvage equals $25,000 minus $10,000, $15,000. Terminal cash flow, $35,000. This terminal cash flow is added to the operating cash flow in year 4. Putting all the numbers we've come up with together on a timeline, we have the values we'll use in the cash flow worksheet to find NPV. NPV, minus $4.03 million. IRR, 9.3% versus a cost of capital of 10%. MIRR, 9.6%. Payback, 3.3 years. With these results, the project is a no-go. This shows the top part of an Excel worksheet to set up and solve our project analysis. This displays all of the given data. In the real world, this is how you would want to set up this type of analysis. Putting all the given data at the top keeps it together, so if anything changes, you can change it in one place. This details the depreciation and after-tax salvage value calculations. And this is the pro forma cash flow portion. Don't forget, depreciation is added back, net working capital is recovered. The bottom line recaps the value to be used to find NPV, IRR, etc. And finally, our calculations. NPV, IRR, and MIRR are Excel functions shown to the right of the values. Payback and discounted payback can be found using logical if statements as shown at the bottom. This shows the whole worksheet with the various sections highlighted. All background data at the top. Note the red line. Everything below the red line, except the depreciation percentages, should be picked up from or calculated from something above the red line. Next comes the depreciation section, after-tax salvage value, pro forma cash flow, and finally the Excel functions. Going back to our project pro forma, what if we expect inflation to increase by 5% every year of the project? This will bias the NPV downward since the cash flows as originally estimated do not consider inflation. But the cost of capital is based on nominal rates and does include inflation, so NPV will be biased downward, not the result we want. So we need to build inflation into our forecasts. To demonstrate further, look at the basic NPV equation. Cash flows in the numerator are real, no inflation. Yet the weighted average cost of capital in the denominator is based on nominal rates with inflation included. Nominal rates are greater than real rates. The cost of capital is a nominal rate, but our real cash flows do not include inflation. Result, a downward biased NPV, not what you want if you're trying to sell a project. There are two ways to adjust for inflation in a pro forma analysis. Adjust the discount rate to remove inflation. This sounds like the easiest approach. Adjust one variable, but it implicitly assumes that inflation affects all line items the same, and it doesn't. Depreciation, for example, isn't affected at all. The better approach is to make adjustments on a line item basis. So here's our inflation-adjusted pro forma in Excel. Note that correctly incorporating inflation changed the project from a no-go to a go. Positive NPV of almost $15 million. The first method of risk analysis we'll look at is sensitivity analysis. It measures the effect of a change in one variable on the project's NPV. It answers what-if questions. This table shows a sensitivity analysis on our original proposed project without inflation. We selected 3 variables to focus on: unit sales, salvage value, and cost of capital. For each variable, we hold all other variables constant and let the variable of interest change by plus or minus 10, 20, and 30% and recalculate NPV at each level. Graphing the data from the table, we can observe the units line, the red line, is the steepest and is upward sloping. That means that the relationship between units and NPV is direct. Units goes up, NPV goes up. The salvage value line, the green line, is the flattest and upward sloping. It's again a direct relationship. The cost of capital line, blue, is downward sloping, indicating an indirect or inverse relationship with NPV. When the cost of capital, the discount rate, goes up, NPV goes down. The steepest line indicates which variable has the most impact on NPV. This indicates which variable should receive the closest attention in forecasting. Units. Creating the table of changes is time-consuming. We can get the same result with less computation by calculating a sensitivity ratio for each variable. Note, this formula is not in your textbook. To find the sensitivity ratio, we need the percent change in NPV. We need the base NPV and the new NPV, and the percent change in the variable of interest, the base value of the variable and the new value. We already have the base values, and we can choose the percentage change for the variable, so all we need to do is calculate one new NPV, and we can find the sensitivity ratio. If the sensitivity ratio is positive, the relationship is direct. If it's negative, the relationship is inverse. The largest absolute sensitivity ratio is the variable to focus on. For our project, let's let each of our variables of interest change by a negative 30%. These numbers come directly from the larger table. The percent change is equal to quantity, new minus old, divided by old. For example, for the units, that's equal to a negative 49,676 minus a negative 4030, quantity divided by a negative 4030, which is equal to a negative 11.32655, or a negative 1,133%. Repeat this for salvage and weighted average cost of capital. We have the percentage change in the variable since we selected it, minus 30%. For units, then, the sensitivity ratio is equal to a negative 1,133% divided by a negative 30%, is equal to 37.76. Again, repeat for salvage and cost of capital. Placing these values on the graph, we can see they correspond to the results found earlier. Units should be the focus variable. We've all heard of best case, worst case. That's scenario analysis. Our base case is our inflation-adjusted pro forma. In this example, we feel fairly confident of all the variables except units. This table represents our analysis of the potential outcomes for units, their associated probabilities, and the resulting NPVs. Using that data, we can find the expected NPV and the weighted average of the three outcomes. We'll also compute the standard deviation of the NPVs and the coefficient of variation. If the firm's average risk project has a coefficient of variation between 1.23 and 175, then this project, with a coefficient of variation of 2, is riskier than the firm's typical project. Assuming a plus or minus 3% cost of capital risk adjustment, reevaluating the project at a 13% cost of capital due to high standalone risk, the NPV of the project is a negative $2.2 million. If, however, it were low risk, a 7% cost of capital will result in an NPV of 34.1. Assuming the plus 3% adjustment is appropriate, this project is a no-go again. This ends Part 9 and ends our review of Finance 331.